Hi there, my name is Andrew Macken and welcome to this week's edition of Video Insight. Today I want to talk about China because there has been a lot of news flow recently about how China is planning to deal with its enormous internal debt burdens, and it can be quite confusing to make sense of it all. So first, a framework to think about the Chinese economy. The Chinese growth model for many years now has been primarily investment driven. To fund this investment, China has been effectively suppressing its domestic consumption to drive up savings. These savings have been used to fund investment in things such as local government infrastructure. Now, how do you suppress consumption? Very simply, by keeping interest rates unnaturally low, savers are penalised at the expense of borrowers. Now, Australians can probably relate to this idea. In China, the savers are the households and the borrowers are the corporates and the local government entities that have been driving China's heavy investment over recent years. Now, the problem, of course, arises when the investments that are being funded are not economic and are not generating enough cash flow to service the debts that are funding them. In a Western-style economy, this would typically lead to the lenders becoming worried and reducing the credit to such borrowers. This reduced liquidity would likely end up in defaults, which many observers are worried about in China. Yet over the last few days, it has become clear how China intends to deal with its enormous internal debt burden. Beijing has ordered its banks to continue lending to such projects, all $4.5 trillion worth, and even if they are insolvent. So this is commonly known as extend and pretend. And it is not a new strategy. Indeed, this is precisely the strategy that the Europeans are following to deal with their public debt burdens at the moment. So what does this mean for China exactly? Well, it means the following things. China is unlikely to have a Lehman-style credit event, which is very good news. Liquidity for Chinese borrowers will remain ample, irrespective of the creditworthiness of the borrower. Now, the less than good news is that China's policy of consumption repression is unlikely to change anytime soon. Many are calling for Chinese consumption growth to offset slowing growth in fixed asset investment. This is unlikely. Instead, aggregate growth will likely slow substantially. Indeed, as interest rates are falling, which is great for borrowers, this actually suppresses the wealth of the Chinese households even further. So lots of new lending in China will be used to refinance prior lending, which is not a particularly productive use of money, but certainly serves to avoid a credit event. As a result, Chinese economic growth will probably be a lot weaker for a whole lot longer as the country slowly but surely deals with its internal debt burden. So I'll leave it there. I hope this has been helpful in some way, and I hope it assists you in making sense of some of the ongoing news flow that you might be seeing about the world's second largest economy.